discussing divergence. Basically, as you know, on the strategy I use QM patterns. I trade QM patterns and I have to line them up with what is called divergence. Firstly, let's dive into the definition of divergence. Divergence in trading refers to a situation where the price of an asset is moving in the opposite direction to a technical indicator, typically an oscillator like the RSI, moving average, MACD, or stochastic. Divergence is often used as a signal that the current price trend may be weakening, potentially leading to a reversal or correction. So there are basically two types of divergences that you can find. You can either find a bullish divergence or a bearish divergence. Bullish divergence occurs when the price of an asset is making lower lows but the indicator is making higher highs. This suggests that while the price is still falling, the downtrend momentum is weakening, which could signal a potential upward reversal. Bearish diversion, on the other hand, occurs when the price is making higher highs but the indicator is making lower lows. This indicates that despite the rising price, the upward momentum is weakening and there may be a potential for a downward reversal. Okay, so as you know, when I use divergence, I use the AO, which is called the awesome oscillator. As previously mentioned, you can use either stochastic MACD or other indicators to find your divergence, but I prefer using the awesome oscillator. What is the awesome oscillator? The awesome oscillator is a momentum indicator designed to measure market momentum by comparing the 34 period and 5 period simple moving averages of the median price. It is often used to confirm trends or possible reversals, similarly to other indicators, and divergence plays a key role in its application. So this is the awesome oscillator, and it has, as you can see, the green bars and the red bars. You can change your colors and decide whichever colors you want to use. So basically the green bars, a green bar indicates that the current value of the AO is higher than the previous value. This suggests that bullish momentum is increasing, as you can see, is increasing and the market could be strengthening in an upward direction. Whereas the red bars indicates that the current value of the AO is lower than the previous value. This suggests that bearish momentum is increasing and the market could be weakening or turning or about to turn downwards. So green bar increasing bullish momentum, red bar increasing bearish momentum. Before we jump into the application of divergence and identifying previous market structure where divergence has played a role, it's important to remember what we mentioned on the first video where we spoke about the phases of the market, whereby you have an accumulation phase and market moves up. You have a reaccumulation phase, market goes up. You get to a distribution phase, market goes down, and a redistribution phase, market continues down. And remembering that this phase up here is called the mark up phase and this phase down here is called the mark down phase. It's important to remember, as I've mentioned before, to know on which sides of the market do you look for buy QMs and which side of the market do you look for sell QMs. So as previously mentioned on the previous video, on this side of the market you're looking for your buy QMs and on this side of the market you're looking for your sell QMs. So when you're on this side of the market you're also looking for your bullish divergences, and on this side of the market you're looking for your bearish divergences. And here you'll most likely find a bearish divergence, which will tell you that the price is about to change its direction. So let us jump to a few examples of how to spot your divergences. Remember that we have previously explained that you find your divergence when price is doing one thing whilst your awesome oscillator is doing another. As you can see, the price is making lower lows whilst the awesome oscillator will be making higher highs. So let us jump to these few examples. So right here in the market, you can see that the market is making lower lows, but when you look at your awesome oscillator, the market is making higher highs. From there, you see that you have a divergence. Move on to the next example. Remember, divergence is when the market is doing one thing, whereby the awesome oscillator is doing another. They're doing opposites. As you can see right here, the market was making higher highs, whereby whilst the awesome oscillator was making lower lows. So we have what you called divergence. Another example, the market is making lower lows whilst the AO is making higher highs. Another example, the market is making higher highs, awesome oscillator making lower lows. So from these examples, you can clearly see that every time you get this situation, which is called a divergence, the market moves, starts a new trend. As you can see, it starts a new trend, a new trend. As we move on and elaborate further on divergence, it is important to note that there are two types of divergences that we have. We have regular divergence and hidden divergence. Previously, we were busy discussing regular divergence, and now I'm about to introduce you to what is called hidden divergence. Hidden divergence in technical analysis is a concept used in trading to identify potential trend continuation signals. Unlike regular divergence, which often signals a potential reversal, hidden divergence suggests that the current trend is likely to continue. We have hidden bullish divergence, whereby the price makes higher lows, and we have hidden bearish divergence, whereby the price makes lower highs whilst the oscillator makes higher highs. So, as you can see on our screens, you can also see here, before we even move to hidden divergence, you can see right there we have our regular divergence, whereby the price is making higher highs whilst the oscillator is making lower lows, signaling that this price will go down. As you can see, it's already started moving down, but we are not on that anymore. We are now on hidden divergence. So as explained, it's hidden divergence is mostly found in trending markets, and it's for trend continuation. So when you have your situations of rally, base rally, you see, when you have a trending market, that's when you most likely to find your hidden divergence. So as you can see here, first example, the price is making higher highs, it's in an uptrend. So the continuation pattern right here, you see it's a continuation pattern right here. The awesome oscillator is making lower lows, as you can see, making lower lows, while this is making higher highs. Therefore you have your hidden divergence. Another example, downtrend, the market is making lower lows, while by the awesome oscillator is making higher highs, as you can see. Another example, the market is in an uptrend, the price is making higher highs, whereby the awesome oscillator is making lower lows. Another example, uptrend, the market is making higher highs, whereby the awesome oscillator is making lower lows. So as you can see from there are so many examples to find in the charts of this demonstration of hidden divergence. It's important to be able to identify the different types of divergences that you'll find, because when you find hidden divergence, you want to be moving with the trend. When you find regular divergence, you want to be changing your trend. Okay, so before we jump into trading QM patterns with our divergences, it's important that we go back a few steps back, where I remind you guys what is a QM pattern. A QM pattern occurs when the price creates a break of structure and a change of character. As you can see right there, that is our break of structure. Right there is our change of character, and then from there it comes back to retest where the break of structure was and starts moving in the opposite direction. The buy QM pattern happens the same as well, where we have a break of structure and a change of character. You see right there, that is our break of structure. Sorry, that is our break of structure, and that is our change of character, and the price comes back to retest the area where the break of structure was. So when you're trading these type of QMs, the simple QMs, you will be using your regular divergences. Regular divergences meaning you'll find them where the trend is usually reversing. But when you're trading the hidden divergences, it's a bit trickier there because the divergences usually look like this. How do they look? Basically, usually look like this. Price will go up and then after a while come back and do that. Most of the time, look like a liquidity sweep. So your hidden divergences, which will occur in continuation trends, they will mostly look like that. You see, in a trend, and then they mostly look like that. So let us jump into some examples. So here, as you can see, we have this normal QM. Therefore, we will be looking for regular divergence, and as you can see here, the price was making lower lows, whereby this AO was already starting to make higher highs, and therefore, as you can see, break of structure, right? Break of structure, change of character. We have our QM using what? Regular divergence. Another example we can find is right there. Remember, as I've explained before, this is the hidden divergence type of QMs. These are the hidden divergence type of QMs whereby you'll have something like this, some liquidity, and then the market comes back later to sweep all that liquidity and start moving in a different direction. And as I've explained before, the hidden divergence is mostly a continuation pattern. As you can see, the price was making higher highs. This is higher than that, but the AO made lower lows. So, and also, your QM pattern, you have your break of structure there, you have your change of character there. So it's a normal QM pattern, but these ones are harder to find because they use hidden divergence. But you look for these when you are trading price continuation patterns. Let's look at another example. Another example right here, we have our regular divergence whereby we have our break of structure there, a change of character there, some liquidity, and price came back, swept and moved down. And as you can see on our AO, as the price was making higher highs, the AO started making lower lows, signaling that the price is going to change direction. Let's look at another example, and that is regular divergence. Another example whereby we have our break of structure. As you can see right there, we have a change of character right there, and price comes back to retest the area of the break of structure. When that is happening as well, you notice that as the price is making lower lows, the awesome oscillator is making higher highs, and therefore you have your regular divergence. And as we previously discussed, regular divergences are mostly found on your trend reversals, trend reversal areas. And lastly, let's go through the last example, which recently occurred. Remember, as I've previously mentioned, this is a hidden divergence type of QM pattern, where it's also a continuation pattern. As you can see, the price has been making an uptrend, so it's continuing its uptrend. We have your normal QM pattern, break of structure right there, and you have your change of character right there. And as you can see, this is lower than that, but on your AO you can see it's saying that is lower than that. So right there we have our hidden divergence signaling that the price will continue moving up, and it did exactly just that. So just familiarize yourself with the two different types of divergences and know when to apply which one, and from there like your QM trading will go smoothly, because trading the QM patterns alone is not enough. So that's why we use our awesome oscillator as confirmation that the price will actually move in the direction that we anticipate. Drawing this on its own means nothing if you don't have further confirmation. So go through the first video, understand what QM patterns are and how to draw the QM patterns in your chart, and move to this video to understand how to apply the divergences in order to combine it all and create your own strategy. So thank you for watching, and please look out for the next video when we go into more details on how to trade the QM strategy.